Sales goes to the income statement. Purchases, income statement. Carriage on purchases, income statement. Wages, income statement. Then motor vehicles, rent and rates, bank interest, interest on loan, sundry expenses, all of that goes to the income statement. Then loan from Sean, trade receivables, trade payables, then fixtures and equipment, motor vehicles at cost, provision for depreciation of motor vehicles, bank OD, capital and drawings, all that goes to the SOFP, Statement of Financial Position. So in the income statement, we start by recording the sales revenue. Sales revenue, then minus cost of sales. Under cost of sales, we start by recording the opening inventory. Opening inventory is what they have given here. 1st May 2020. Then plus purchases, plus carriage on purchases, and then minus the closing inventory. That's the inventory at 30th April 2021. Then you get the cost of sales. You deduct the cost of sales from sales, you get the gross profit. To that we add other income, then minus other expenses. Now, another additional information says that rent $500 were accrued. The rent paid during the year is $5,000. But after paying that $5,000, there's still another $500 which is still owed. So in the income statement, we have to add this $500 to the $5,000 paid. Then for wages, it says wages $1,000 were prepaid. Wages paid during the year is $20,000, but inside that $20,000 is $1,000 that have been paid for the next year. So it's not relevant. Therefore, we need to remove that from 20,000. This 500 is an accrued expense, which means we have received a benefit or a service but we have not paid yet. So we owe them. It's our payable. So this 500 will be shown under current liabilities as other payables. The 1,000 is a prepaid expense. We have given the money in advance but we have not received a service or a benefit yet. So it's our receivable. So this 1,000 will be shown under current assets as other receivables. Then in the SOFP, let's see how you calculate the depreciation. Fixtures and equipment, the cost. According to the question, the cost is 100,000. There was no provision for depreciation given for fixtures and equipment. It says here, depreciation is to be charged on fixtures and equipment at 25%. So 25% on cost. It's straight line method. So cost 100,000 into 25%, that's 25,000. That's the amount you'll be recording under other expenses saying depreciation on fixtures and equipment, and that's the same amount you'll be deducting as accumulated depreciation from cost to find the net book value. For motor vehicles, they say motor vehicles are to be depreciated using the reducing balance method at 40% per annum. So under reducing balance method, how we calculate it is cost minus accumulated depreciation into the percentage. Cost of the motor vehicle is 400,000. The provision for depreciation amount they have given is 80,000. So 400,000 minus 80,000, you get a net book value of 320,000. That into 40% gives you 128,000. So the depreciation charge for the year is 128,000. That 128,000 is what you record as other expenses in the income statement for depreciation on motor vehicles. Then in the cost column, you record the original cost 400,000. Then for accumulated depreciation, you add up the provision for depreciation amount, that's the opening balance of the provision for depreciation amount plus the current year's depreciation. That total 208,000 have to be deducted from cost to get the net book value.